Today's episode of the Daily Recap Show is brought to you by the Bank of Japan. Raised rates by 25 basis points and crashed the global market.
Object to the test!
Okay, story time. When I was a young boy, my dad told my mom and I that he was going to go on a business trip and that he'll be back in November and bring me back a souvenir. And so I believed him and waited and waited and waited. And then November came, and then my dad came right back on schedule and brought me 2 souvenirs. And that is why I'm an optimist, and that is why I buy the dip, because good things come to those who wait. So,
thanks, Dad.
In other news, stocks fall, consumer weak, yields rise, blah, blah, blah. Let's roll the tape. Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. Now, this is the daily heat map of the S&P 500 and a very mixed day. In fact, this heat map was very green at the start of the day, and then we saw lower highs and lower lows into the close, led by Nvidia. Semiconductors, they were down big, 4.24% in AVGO, Nvidia down 3.82%. What didn't help these guys was SMCI's earnings, not that great, but Nvidia was up about 4% in the open, so it wasn't necessarily SMCI's results that actually caused this sell-off right here. In fact, the broader market was green. What caused the sell-off today was actually a 10-year bond auction, a $42 billion sale for US Treasuries that just went terribly, absolutely terribly. The yield tailed, dealers had to pick up so much of the supply. The market didn't like that, and when you have ongoing Japan concerns, ongoing macro concerns, and T-bills still paying you 5.3%, why would you buy a 10-year treasury? That weighed on the market, and that's why we continue to see a rotation into defensive sectors, stuff like utilities, consumer staples, as well as rate-sensitive stocks, stuff like financials. And major cyclical components of the market still continue to get sold, stuff like materials, discretionary, and industrials. And then technology also got sold on the back of Nvidia. And when you have stuff like technology, discretionary, which are 2 huge sectors, down 1.7, 1.8% respectively, you are going to get a red day in the S&P 500. And all of these factors today led to the price action we saw, where defensives led and the rest of the market was sold, including small caps and mid caps, but it wasn't all red from the start of the day. The markets opened very bullishly, and then when we got that bond auction, we just kept making lower lows to lower highs. Other days losses around 130 and then continued to move lower. We did find a little bit of a bid up here at about 3 p.m. into the market open, but I think this was just probably shorters taking a bit of profits, especially those that got in anywhere before 130. And we saw the S&P 500 down 0.67%, the RSP down 0.73%, Nasdaq 100 down 1.14%, and the Russell 2000 down 1.15%. Breadth for all of these indices were not that great either, and just a vicious day of red. And when you don't have a lot of economic data to go off, you're going to take the lead from a 10-year bond auction and you're just going to run with it. That lead was not good, and that's why the market sold today, along with all of the other fears and concerns that the market is grappling with: Japan, the economy, rate cuts, all of the above. And even the stellar earnings we're seeing in the S&P 500 right now was outweighed by the fact that we got a weak 10-year bond auction, and by the fact that we are in a daily downtrend. But there was some very constructive things in the market today that was supportive for higher price action into the rest of the week, into next week, and also some mildly concerning price action. Now, regardless of the 10-year bond auction, if we actually just look at something like the basic RSI, we are approaching oversold conditions right here. This does look like a great place to start buying, and we are seeing constructive price action to some degree of a bottom forming, especially at a key level. If we just look at the year-to-date chart, right, let's actually just take these candles and just put it on a line chart. And then what do you see right here? It's very, very obvious what we're seeing. We got a low. This is the start of the year. We put a low right here. Then we formed a high, pulled back, put in a higher low relative to this low, continued higher, put in another low right here, a minor low, I would say, then continue the move higher. In fact, you could say this is just one move, put in a high, and now we're pulling back. And really, if we actually form a low right here and continue higher, we would actually just be making higher highs, higher lows, with multiple new all-time highs on the way up to here. If we do put in a low that would simply mean trend continuation onward and upward, and then you would look to new all-time highs. Ideally, if the bears really want to get the sell-off going, they have to take the S&P 500 to 49.71, at the very worst case 5,000. Now that level is approaching very soon, but what we did see here today in the S&P 500 was actually some constructive price action in the options market. We saw the put support zone move from the 5100 area, it was right here, to the 5200 area, and that's actually where we closed the day off in the S&P 500. Secondly, the gamma flip is still 5300. We did find resistance right here, but we did wick above it, and we did build quite a bit of support here. That's constructive, and this wick was actually higher than yesterday's wick, and we did actually close just inconsequential, but just above yesterday's low. So technically you could say, compared to yesterday, we are forming a higher low relative to the wick low of yesterday. That is the S&P 500. Now these are very small things, and ideally what we want to see is a move up tomorrow, and we're probably not going to get that, because you can see here in the after hours, the QQQ, the IWM, and the RSP are all very red. Same here with the S&P 500, but anything can change in a dime, because yesterday these were red, then they were up like 1.7%. We opened the market in the S&P 500 up 1.7% on the day. That's a huge gap up. If we just actually go one day, right, and turn this into the percentage chart, you see the S&P 500 was up 1.7% at the high of the day. We finished down 0.76%. And yesterday in the pre-market, we were looking at red candles very similar to this. So anything can change in the Asia session, in the European session. But this is the 5-minute chart, non-constructive price action, and this is what you literally get in negative gamma. If you actually just look at it, right, look, when we were in positive gamma above this yellow line right here, this is the 5300 gamma flip zone. In positive gamma, sort of is buying dips, selling rips. Second we get into negative gamma, right, you see these sharp candles right here. These sharp candles move down, very minimal pullback, sharp candles down, sharp candles down, sharp candles down, lower lows, lower highs in the S&P 500. But the options market is telling us people are liking the price action right here, and we have seen quite a bit of buying, including from hedge funds. Hedge fund data saw a net buying on Monday as well as Tuesday, so we'll see how that materializes. But the market is definitely struggling at this 5300 zone, and this is a zone that the market's going to need to like push above, build support if it wants to move higher. Otherwise, I think bears are going to keep coming and selling the 5300 area. So this is the line. You really want to get above this gamma flip, then we can look to higher levels. And as long as we're below the gamma flip, we want to aim for the put support. We'll see if it moves back down to 5100 tomorrow. But as it is right now, I think things are looking constructive for somewhat of a bottom until we actually go ahead and take out this low right there. Until that happens, I think this is a great place to buy in the S&P 500, and I am a buyer, especially in high quality stocks. Now, looking at something like the Nasdaq 100, looking actually a lot more constructive than the S&P 500, but it has fallen significantly. The peak to trough drawdown right now for the Nasdaq, actually looking at about 13%, 15% at its worst. We actually haven't gone and made and hit the lows that we saw here on Monday. And actually on a year-to-date chart, very similar to the S&P 500, you know, until we actually go ahead and break the 17,000 level, this is looking like a higher low in the Nasdaq 100. Things look a lot different for the IWM, however, because if you look at the year-to-date chart, we're sort of back in this balance zone right here, and you know, small cap investors are going to have to work really hard to get us back above the 207 210 range, back to these 52-week highs. But we did go and make these highs, and that is constructive, I guess. It's just that the rally happened a bit too late when sentiment turned at the wrong time. If we actually pull up the weekly chart though for the Russell 2000, you could see that realistically, as long as we stay above, you know, these lows right here, we should actually pivot very similarly to the S&P 500 and Nasdaq, form a higher low and continue the move higher back to those all-time highs. But it's really going to depend, and this index is a bit of a shit show. If you do want something more constructive that looks a lot better on the chart, look at the SP 600 or maybe something like the CAF index. This thing literally outperforms the IWM to the upside and the downside, where the IWM actually made lows right here. The CAF index actually didn't quite make those lows. Still a higher low, but we'll see what happens tomorrow. And a lot of the price action right now is going to be dependent on where the price action consolidates relative to Monday's lows. I think, you know, if we really break below Monday's lows right here, things are going to get very, very hairy for stocks. But if we stay above, maybe even just consolidate at this area, we definitely don't want to close below this wick low, but we could sort of wick below it but close above it. But if we just consolidate in this area, that is probably the signal that we are going higher. It might take a couple weeks, it might even take a couple months. We are in a seasonally weak period in the S&P 500 and for stocks in general. But if Monday's lows don't get broken, this is constructive and we probably go ahead and retake all-time highs. And realistically, from Monday's lows to the highs we saw middle of July, that's a 10% run right there. So 10% back to new all-time highs. Very, very constructive. In other news, we actually did see yields increase here today. Yields were up 1.21%. The 30-year yield was actually up 1.58%. That was on the back of the 10-year bond auction. It wasn't necessarily tied to a stronger macro backdrop. It was just the yields getting tailed and the market reacting accordingly. We saw bonds as a result fall. TLT was down 0.7%. The dollar did gain 0.24%. That's always going to happen in a weak bond auction. And then gold, despite everything we're seeing, not really making a move to the upside, which is very, very weird. You think weaker macro, 4 rate cuts priced into the market, you think gold would absolutely rally, but that is not the case. It's actually come down. A lot of people who bought the rate cut news in gold probably feeling a bit of pain, especially at these highs right here. But this chart looks very, very strong for gold. And this is an all-time high for gold, an all-time high close just a couple of weeks ago. And I do think gold probably goes higher into the end of the year. Silver, looking atrocious, but it's had a massive year-to-date run. What is the return on a percentage basis? 11% up for the year, outperforming something like the S&P 500. And then crude up 2.77%. Very interesting day for commodities. Very interesting day for the market. Not a lot was going on. Today was really just that bond auction dictated everything. And that's just the thing with low data weeks. The market will find a lead and take a lead and go from there. And that's the price action we saw here today. But guys, I am a buyer in both the S&P 500, the names that I like, small cap quality in particular. I will be buying in the Australian session. I do think equities are attractive at this point, and if we go lower, I will continue to buy. I am a long-term bull. I have a very long-term time horizon. So this to me is a fantastic discount. And the S&P 500 up until the summer had one of the best starts to any year ever in 2024. At one point, we were up 18% for the year. However, this pullback has brought us back to the mean near the median S&P 500 return. And it's very interesting when you zoom out, things don't look that bad. And ideally, if you're a technical chartist, you stay above this line right here, make a higher low, and continue higher into the end of the year. That is a very solid looking chart going into 2025. But the reason why the market actually panicked is simply because the pullback we've seen in the last couple of days, or I would say the last 5 to 10 trading days, has actually been sharper than the average bear market. This blue line right here is the average bear market. This decline has been slightly sharper, and this was because of a whole range of factors coming together at the same time. The Fed, Japan, earnings, weak economic data, inflation, it all culminated in the sell-off we're seeing right now. And this violent pullback has actually coincided with market sentiment getting into extreme greed here on the fear and greed index. We were at neutral just a week ago, and actually in this week right here, we actually did tick into the greed zone ever so slightly. We have now moved all the way back to the extreme fear zone, and that just goes to show the sentiment in the market right now. Things changed on a dime, but for all of the panic we've seen, credit spreads have actually remained largely unchanged. Yes, we did see a tick up, but just for reference, this right here, okay, is actually the SVB banking crisis we saw in 2023. And yes, we have seen credit spreads tick up in the BAA corporates, but nothing significant that we should be worried about. And the same is true for AA corporates. In fact, a far milder uptick in investment grade credit. And if you want to see a sustained pullback that won't get bought in the near term, you want to see credit spreads blow out, and we're just not seeing that right now. And at the end of the day, guys, volatility is simply the price we pay to invest. You can see that we get a 3% dip about 7 times per year. Stocks are very mean reverting. We get a mild correction 3 times a year. A 10% pullback happens actually more than once every single year, and a severe correction happens once every 1.5 years, or 0.7 times every single year. And the volatility we're seeing, guys, is actually completely normal, especially in years when we've had a very solid May to July. After a positive May to July, August tends to be that counter trend month. We returned 9.52% in this May to July period, and subsequent returns historically have been fairly lackluster, negative 0.57% average, negative 0.65% median, 20 up years, 26 down years, a terrible hit rate. And that's why the volatility we're seeing in the market right now is completely seasonal, completely normal, and what actually happens on an average year. So buy the dip. Now guys, looking at earnings, I didn't actually get to all of these companies. I think I saw CVS Health and Novo put out fairly alright earnings, but the market reaction were very subpar in these. I didn't get to look at Walt Disney. That's definitely a company I want to dive into a little bit deeper. I did look at Robinhood. I thought their quarter was very solid, and I did actually do a deep dive into Shopify because this is a stock I've been looking at quite some time. The stock was up like 25%. They beat on revenue, they beat their GMV estimate, they beat their EBIT estimate, they beat their free cash flow estimate, and beat EPS estimate by a lot. I think the EPS estimate was 0.06. Management reported 0.2. Huge beat on the EPS side there. Actually a very strong quarter, and I think they slightly raised guidance as well, and that's why the stock was up 25%. So great little stock right here. I regret not buying it, but I'm still in the research process for Shopify. All in all, I thought today's earnings were actually pretty good, and I thought earnings this week so far have been pretty good. Tomorrow we actually have another big day. We have Eli Lilly, SoundHound, Vista Energy, Elf, Plug, Unity, Datadog, Paramount, the Trade Desk, so a whole bunch of companies reporting. So let's quickly recap earnings. This is LSEG's data right here as of August 6, 2024, and they see S&P 500 second quarter earnings so far 13.7%, blended revenue at 5.5%. Look at that technology revenue plus 10.4%. That is crazy. They see the earnings surprise factor for the S&P 500 4.1%, the revenue surprise factor at 1.3%. And in my opinion, very solid earnings, and the fundamental picture remains unchanged for equities. When earnings are growing, you want to hold stocks. Now diving into some macro, this is the Fed's GDP now, and we finally got an update right here, and we've seen an uptick from 2.5 to the 2.8% in the Atlanta Fed's GDP now. Very surprising despite the non-farms data. And while everybody's worried about economic growth, Goldman Sachs boosted their GDP forecast to 2.6% and the Fed's GDP now actually to 2.8%. And this was in large part driven by auto sales, M3 to 2 manufacturing, construction spending, as well as the ISM services index. And I'm assuming that this number was actually brought down by the NFP report. So we're probably looking at a situation where if non-farms came in line, we're probably looking at a 3% or maybe 3.1% GDP tracking, which is very interesting. So growth looking robust, and this is why I'm actually buying the dip. But I do pay attention to the risks, and one of those risks is the consumer. Delinquencies are ticking up in a very big way, and the big one we're seeing is actually mortgage rate delinquencies right here, just under the 4% mark, which is at about pre-COVID levels. So nothing to be concerned about, but the trend is up. However, student loan debt continues to weigh on all of this, and auto loans and credit cards are ticking up in a very big way. And what's so concerning about the student loan debt is that if this starts to tick up in any material way, let's say Joe Biden stops giving student loan forgiveness or whatever's keeping this subdued, if this ticks up in a big way, what happens to credit cards, auto loans, mortgage payments? It's yet to be seen. So the consumer in certain parts looking rather weak, and that is a big concern for the US market, and I think something that's not fully discounted, and we saw that come into view this week. When there's macro risks, especially with how weak the consumer does look on certain metrics, you're going to see the market sell, you're going to see the market liquidate. And that's part of the reason why we saw the sell-off we have in global markets this week. And this is in sharp contrast to default rates. Default rates are actually falling, and while they are elevated compared to 2022, we can see that they're roughly in line with the pre-COVID averages. Default rates are falling, and that just means that the consumer, yes, while delinquencies are increasing, those delinquencies aren't turning into defaults. In fact, we're seeing the opposite. And another measure of the consumer is actually gasoline demand. Gasoline demand in 2024 tracking above 22 and 2023, and Goldman says gasoline demand looks solid.